Business loan versus equipment leasing, which one actually makes most sense in your stage of business or what your business is actually doing? And most equipment financing denials don't happen because of credit. They happen because the business chooses the wrong tool for its stage. So most people ask, should I lease or should I get a loan? And that's like asking whether you need a hammer or a saw without knowing exactly what you're building. And business owners are taught one dangerous idea. If I don't own it, I'm losing money. And that's not true early on because early in business, what is most important? Cash flow. And matters more than ownership. A loan is about ownership, a lease is about usability. One builds equity, the other builds revenue. And trying to own too early is like buying the building before you tested the business inside it. Now, here's stage one. Those are new businesses, let's say 0 to 24 months. Now, at this stage, you have limited financial history. Banks typically say not yet, and cash is oxygen for the business. Leasing works because equipment is the collateral. It's less paperwork, faster approvals, and revenue starts immediately. And you're not buying the machine, you're renting the machine that moves the business forward. Now, one thing I want to say, there are different types of leasing, and definitely watch for the next video as I'll talk more about mark that. So stage two, the growing business, and that's 2 to 5 years. So now you're in transition, and this is where strategy matters. Some equipment should be leased, rapid depreciation, technology changes, revenue generating tools. Other equipment should be financed. Other equipment should be financed. So those equipment, let me say those again. Rapid depreciation, technology changes, and revenue generating tools. Those are some of the type of equipment that should be leased. Those are the equipment that have obsolescence or equipment like computers and things that just the value goes down very quickly, right? Other equipment should be financed. Those are the ones that are longer life equipment. So they're the core to your operations and they have stable usage. And this is where businesses either scale or accidentally stall. Now, stage three, those are established businesses, so 5 years plus. Now, ownership at this stage makes sense. You have strong tax returns, predictable cash flow, better rates, longer terms, and loans now reduce the total cost. At this stage, leasing isn't wrong, but loans finally become efficient. Now, what is the biggest mistake when people make a decision between a business loan and financing equipment through equipment leasing? People choose financing based on interest rate, monthly payment, and what sounds smart. But instead of choosing on basis on their stage of business, the cash flow, timing, and future funding goals. And that's how businesses get tracked, not from bad equipment, but bad structure. Now, the goal isn't owning equipment, the goal is owning options because the business that survives is not the one with the lowest rate, it's the one that keeps access to capital open. And funding should never slow your business down. It should carry it forward.